Hello, everyone. This is Eric, head trader at TaylorTrader.com, and I wanted to do a trade review video of two trades that a person trading our strategy sent in to us. Now, here's two trades here and the entries and exits. I'm not going to explain strategy so much in this video, but more focus on the psychology of the market, both on a kind of like the trap that the market lurks you into, and then also kind of like a risk management video, because the main reason why which prompted this video is what you're looking at here is a stop out, which is equated to about a 10% loss in one trade, basically overnight. Furthermore, it's pretty much it's spent 90, I say like 95% of the time against the strategy. So let's take a dive in to figure out why it is what had happened here. So if I dive into the charts, this is kind of a layout that you see at TaylorTrader.com. Again, I'm not getting into the strategy, but we have a weekly chart here, followed by a daily, the 240, which is a 4-hour R time frame that we focus on for entries and exits. And then we have a 60, a 30, which is our literally our execution time frame, and then followed by the 5. Okay, so I want to dive into the 30-minute chart, which we use to execute. What you see here, I overlaid the chart where the proof of trading and the entries and exits, which you've already seen, and I have the chart under here. So here's where the trading took place. Trader went short 1900s, which is right here. So his short here stopped out on this spike, as you can see here, got frustrated by being stopped out on the short side with that little spike, ended up going long on a admittedly impulsive trade out of sheer frustration. Also note the trader actually went in on with 4 times the average size of what he should and has been trading with the account. So that's also a mistake that I'm going to get into a little further. And then ultimately, of course, went long and short, and I'm going to explain the details of the kind of the trap of the market and the context of the market. But mistake number 1, going long and short when there's no where the period of the market is consolidating, and then mistake number 2 is and also not following the strategy. Mistake number 2, and a very big mistake, is sizing in to a trade 4 times, and then of course at least he put a stop loss here, losing 10% in an account via one trade. And there's where the stop outs are here, with the entries to go long here, and then getting stopped out down here. So here's the chart here, and then here with the entries, and then here's the actual chart. So let's just take a dive in. Now, it's very easy. Don't misinterpret the context of this video. It's very easy to look at a chart after the fact and say, oh, you should have done that. Trust me when I say I am not that guy. However, you should be looking at your trades and seeing what you did good, wrong, etc. And of course, not over leveraging in one trade, risking 10% in one count. Again, I'll say that I've done that mistake personally multiple times. Obviously, I don't do it anymore. But you can't fall into the market traps. So what we see here, I'm not going to talk about strategy to respect my members, but we obviously have a big move down. And again, we looked at this at this market. It printed a bearish reversing on a daily candle, and this is what the formation, what you call a flag pattern. Now, this is a consolidation pattern. You don't know it's going to break out until it actually does. But let's look at this objectively. While this trader was taking this trade, he went long and short, all in a period of a consolidation. These Bollinger Bands, I have this strictly on so you can visually see the Bollinger Band collapse into volatility. That is already a mistake that this trader made, going long and short both ways ultimately not getting any move and getting stopped out long and short because the market's just consolidating. It's going to trap traders in. Taking a step back and looking at the actual formation from the higher time frames, then scaling into the smaller time frames and executing, you will then wait, impatiently wait for your entry trigger or not to happen, and then execute as the market is showing that sign. Now, we operate that in the room, but I do want to make a point that the trader ultimately risks 10% over leveraging, putting a stop. And I want to make a point that the market actually did provide a signal later in the day, a signal, and had the capability for the trader to then get in and exit via the way we enter and exit the market properly if they had just waited, right? So the lesson learned here is don't oversize, don't over leverage. I know it's frustrating. Proper trading is frustrating. The market sucks you into these consolidated traps, and they want you, they meaning, you know, market makers, and, you know, the market itself works that way. It sucks in the weak, and then ultimately you get stopped out, risking a big amount, which you shouldn't. In this case, he did, risking a big amount in one trade. Now the trader wakes up with a 10% loss in the account, which is just a bad way of trading. Now, I do want to say the formation actually did form very, very good, and we actually did have a signal. It's unfortunate that the trader was trapped on the wrong side. The whole context of the way Taylor Trader works is we trade the trend hard right edge. So he eventually just got trapped on the wrong side, ultimately just accepting his fate of the stop loss and looking at a 10% loss, which I said multiple times. So you can't fall into that trap. Ultimately, you have to be patient, disciplined. If the trade is going to work out, your strategy should provide an entry or exit, for that matter, signal to take action. You cannot over leverage on trades that ultimately are just not even showing an edge. There's no edge in here. A patient professional trader is going to wait for an edge to show itself, and then only then do you have signal to enter via your strategy, and then you execute that stake. Here, this trader went long and short, all in a 20 pip range. Market's not doing anything. The higher time frames are giving you a context in which you should trade, ultimately getting signal later in the day, but unfortunately this trader was trapped into long short scenario, over leveraging one way, being trapped on the wrong side, taking the trade with a loss of 10%, all while what the trader was waiting for eventually happened. And trader did not make money and actually lost money on that trade. So this is the whole point. Professional traders know how to operate in and out of the markets. I clearly, again, I don't want to get into that hindsight. The lesson learned is don't over leverage, be patient, wait for your setup to occur. Being early is wrong. Wait, patient, execute on the other side. TaylorTrader.com, we do this on a daily basis.